Hello and welcome to another session of the My Solo 401k Financial daily webinar series. We're about to get started. We're excited today to discuss the C-Corp Solo 401k deadline of December 31st to lock in tax deductions for 2025. If you have questions or topics that you'd like to discuss, please chat those over and we'll go through those sequentially. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. As always, again, we're here to help you stop overpaying taxes and start building real retirement wealth. Again, today's topic is the C-Corp Solo 401k deadline of December 31st, which is the deadline to lock in tax deductions for 2025. Please use the chat now to ask questions on today's topic or anything else. Again, please chat them over now so that we can be sure to get to them all. Let's get started. First question from Jeremy. My question is whether my solo 401k can work with a solo 401k set up as a VIPP account at Morgan Stanley Private Wealth Management. That's a fantastic question, Jeremy. Thank you so much for bringing it. We are totally neutral as far as where the accounts are opened up at. So we are a solo 401k plan provider, and a solo 401k plan is really a legal entity. So it's the documents that create it. So customers use our plan documents along with their advisors to open up accounts at the bank or brokerage of choice. Ultimately, what's most important is that the account is opened up under the name and EIN number of the plan. We obtain an EIN number as part of the onboarding process. So we'll then help open up the requisite accounts. For example, separate accounts will be needed if the funds will be used for multiple participants, like say a husband and wife that are both working in the business, both participating in the solo 401k. You would also need a separate accounts if there's going to be different types of funds, like say pre-tax versus Roth versus after tax. So you've got two participants and each person's making Mega Backdoor Roth contributions. There's going to be 6 accounts, right? A pre-tax, a Roth, and an after-tax for each person. We're happy to help prepare the paperwork that's needed to open up the requisite number of accounts or answer questions. Of course, like I mentioned, we get the EIN number as part of the onboarding process. So we're still very hands-on in helping clients and their advisors open up the accounts that are needed, but we are technically not the custodian. We don't have access to the money, which is why we're neutral as far as where the accounts are opened up at. So hopefully that makes sense. Thanks for bringing that good question. Now let's dive into the topics or to the questions that we wanted to share, the slides we wanted to share. Again, if there are more questions or topics that come up as we go through the slides, please don't hesitate to chat these up so we can make sure to get to them all, or even if you've got other off-topic issues to discuss. We've got one more quick question that came in. We'll definitely get to more questions after we go through the slides. Let's knock out this next one. Can I set up a solo 401k if I'm self-employed as a W-2 employee with employer-provided 401k, but if I have self-employment income through consulting? Most definitely, as long as you're reporting earned self-employment income on your taxes. For example, find a Schedule C if your business is taxed as a sole proprietorship, and there are no non-owner, non-spouse, full-time W-2 employees working for you. So the fact that someone has a W-2 job is not going to prevent or preclude them from being able to set up a solo 401k. So that brings us to the foundation, which is who's eligible to set up a solo 401k. A 401k, like any a 401k plan generally is for employers. A solo 401k is for self-employed individuals with no non-owner, non-spouse employees. So in other words, what they call an owner-only plan. Ultimately, there's 2 elements to the eligibility. One element, or think of it as a prong, would be having that self-employment income. Because to demonstrate that you're self-employed, you need to report earned self-employment income. Could be income reported on Schedule C, if your business is taxed as a sole prop, or a single member LLC taxed as a sole prop. W-2 wages, if your business is taxed as a C-Corp or an S-Corp. Income reported on line 14 of a K-1, in the case of a self-employed business that's taxed as a partnership and files a 1065. The other element, the other prong, is not having any full-time, non-owner, non-spouse employees. So the solo 401k person themselves, they can be a W-2 employee, like in the case of a C-Corp or an S-Corp. Their spouse could be a W-2 employee, and they would still be eligible as long as they don't have any other non-spouse, non-owner W-2 employees. So that means you could have W-2 employees that are working on a full-time basis. So the business could have contractors. It could even have W-2 employees, but you'd have to be very careful to make sure that they don't work on a full-time basis. In other words, they're not working 1,000 hours or more per year with a year of service, or 500 hours or more per year for 2 consecutive years. Ultimately, this could be ideal for realtors, consultants, freelancers, other small business owners, right? It could run the gamut. The nature of the self-employment business doesn't matter as long as you're reporting that earned self-employment income with no non-owner, non-spouse employees working for any business owned by you or a spouse, if any. Some of the top eligibility considerations: do I need a separate entity? No. We have many folks that are operating as sole props. The key is that you're reporting that earned self-employment income. You can even have a W-2 job, even participating in your W-2 employer-sponsored plan, as long as you've got that separate self-employment income. Could be from a side hustle, right, with no employees working for you. Now, the critical deadline, regardless of how your self-employed business is taxed, is December 31st, 2025. That's the key deadline to establish the plan. So you need to sign up with us by December 31st, because that's what establishes the plan. And we'll explain what that means exactly in a moment. But sign up with us by December 31st, 2025, and that'll lock in the ability to make all types of contributions for 2025 by your self-employed business tax return deadline, including extension in 2026. Now, for a C Corp specifically, this could be an LLC taxed as a C Corp, or as a corporation taxed as a C Corp. Here are the key dates. Again, December 31st, 2025 gives you the most options. You can make the most types of contributions with the most time to make those contributions by. In other words, you can make all types of contributions for 2025, whether employee, employer, voluntary after tax. So that means pre-tax employee, Roth employee, pre-tax employer, Roth employer. And again, the voluntary after tax, which is how one makes Mega Backdoor Roth contributions by your C Corporation 2025 tax return deadline, including any timely filed extension. So for a C Corp that files on a calendar year, that's April 15th of 2026. Or if you file an extension for that 11/20, October 15th. Now, if you don't set up the plan by the end of the year, let's say you set it up at the beginning of 2026, you can still make certain 2025 contributions, but you won't have all the contribution types available, and you won't have all the time by which to make it. In other words, all the way up until the extended tax return deadline, in other words. So if you sign up after December 31st, but in 2026, you could still make employer and or voluntary after-tax contributions for 2025 by the business tax return deadline, including any timely filed extension, but you would miss out on the ability to make the employee contributions for 2025. So how do you meet the deadline? Well, you need to establish the plan. How do you establish a plan? Well, a solo 401k plan is a legal entity. So like any legal entity, it's the documents that create it. So we make it very easy to establish the plan, because we will prepare the documents within the same day when you sign up. So it's just a matter of 3 simple steps. You complete our online application that you can find quickly and easily at mysolo401k.net. Click on open account, then click on solo 401k. It's just 10 simple questions about you, about your business. That's how we capture the information we need to prepare the plan documents that are drafted specifically for your business. So we draft those plan documents within the same business day. When you submit the application and make payment, an email goes out with a link to our secure portal where you can download those documents that were drafted specifically for your business. You can sign. You can take your time to return the completed and signed pages. We don't need the pages back by the end of the year. Now, once you're ready to open up the accounts, you'll upload the completed and signed pages. There's going to be a secure upload link in that same email. There's also a link to a quick next steps questionnaire where clients and or their advisors are letting us know where they want to have the accounts at, right? Could be a Morgan Stanley per the initial question, could be a Fidelity, could be at Schwab. We've helped customers open up accounts at hundreds of different banks and credit unions. But again, you can take your time to open up those accounts, because completing those 3 steps by December 31st is going to result in establishing the plan. So now you've preserved the ability to make all types of contributions for 2025, all the way up until your tax return deadline, including any timely filed extension in 2026. So let's really understand those 3 steps. So step 1, complete the online application. Again, that's how we capture the information we need to draft the documents. Step 2, we then, once we receive the application and payment is made, we'll draft those plan documents within the same business day. We use our IRS approved plan documents to draft the 401k plan specifically for your business. That's going to include the plan document, the adoption agreement, the trust agreement, among other documents. We put it on our secure portal. We send an email to the email that was used on the application. You can then access the documents quickly and easily to meet the deadline. You sign the documents. You can use electronic signature software to sign the documents. And then, as I mentioned, there is going to be a secure upload link in that initial email, but you don't need to submit the completed and signed pages by the end of the year to meet the deadline. All you need to do is sign up by the end of the year, and that's what meets the deadline. That's what establishes the plan. You can then take your time to open up the accounts, make contributions in 2026. So now let's shift to talk about those next steps when you're ready, right? Once you signed up, you've met the deadline. You can open up the accounts in 2025, but you don't have to in order to meet those 2025 contribution deadlines. But once you're ready, you simply just return those completed and signed pages. Again, they can be signed electronically if you have electronic signature software. There's a secure upload link to return those completed and signed pages. There's a next steps questionnaire, just a quick 1-minute questionnaire where you tell us where you want to have the accounts at. Once we receive this response back, we receive those completed and signed pages, we receive the next steps questionnaire response. We then go ahead and obtain an EIN number specifically for the solo 401k. This is the IRS expectation that a separate EIN number is obtained for the solo 401k. Practically, it makes sense because let's say that there's tax income that's reported, tax reported with respect to the account. Take a simple example. Let's say that you open up a bank account that's an interest-bearing account. The bank is going to need to report that interest income. They're going to use the tax identification number that was used to open the account. So if the bank account is opened up under the EIN number that was obtained for the 401k, now when the IRS receives that report of that interest income that's earned on a 1099 INT, the bank will understand that the interest income is being earned inside of a 401k on a tax deferred basis. So now they're not going to look for that interest income to be reported on your personal return or your business return like they otherwise would if that account had been opened up under your social security number or your business tax identification number. Once the accounts are opened, you can then fund those accounts, right? You can make the contributions. So if you signed up at the end of the year, now you would have locked in the ability to make all types of contributions by your business tax return deadline, including any timely filed extension. For a C-Corp, that's going to be April 15th or October 15th of next year, 2026, if you file an extension for that 11/20. The other way that you can fund the account is by rolling money over from pre-existing retirement accounts, as long as they're eligible to be rolled over. Eligible retirement accounts are going to include a former employer plan, such as a former employer 401k or 403b, etc., as well as a pre-tax IRA. So you cannot transfer a Roth IRA to any type of 401k per the Roth IRA rules, but you can most certainly transfer pre-tax funds in an IRA, such as pre-tax SEP IRA, a pre-tax simple IRA, a pre-tax traditional IRA. And we are very hands-on in helping customers through those transfer processes. As you might imagine, the process will vary from institution to institution and even from account type to account type. And we've helped thousands of customers roll over funds from hundreds of different accounts at different institutions. And we've tracked that knowledge that we now have in our knowledge base to make it easier for you to help you through the transfer process. So we'll, for example, pre-fill the transfer paperwork so that the provider from whom you're transferring the funds understands that you're rolling the money over to your new employer plan because they'll need to report that rollover to the solo 401k. So it's important to complete the paperwork correctly so that they report it as a non-taxable direct rollover to the IRS. So what do I have to do by December 31st? Well, you need to establish the plan. And we've made clear that the way to establish the plan is the documents. And we make it easy to establish the plan because we prepare the documents. We establish the plan within the same business day when clients sign up. You just need to submit the online application and make payment, and we'll establish the plan within that same business day. Do I have to open the bank or brokerage account by the end of the year? No, you don't. That's not what's needed to establish the plan. A 401k plan is not an account. A 401k plan is a trust, so it's the legal entity. Ultimately, you'll need an account if you're going to be making contributions or rolling over funds. And we're very hands-on in helping customers open up the accounts, but the accounts do not need to be opened by the end of the year. Do I have to obtain an employer identification number by the end of the year, by December 31st, 2025? No, you don't. Again, obtaining the EIN number is not a prerequisite to establishing the plan. All that's needed to establish the plan is the documents. Now, an EIN number will be needed, and we talked about why that's important. It will be needed when it's time to open up the accounts, and we will obtain that EIN number from the IRS as part of the onboarding process, but it doesn't need to be obtained by the end of the year to meet the deadline. Is the tax return deadline my personal tax return deadline or my self-employed business tax return deadline? It's the business tax return deadline. So it's the 11/20 deadline in the case of a business that's taxed as a C corporation. So that's April 15th of 2026, or if you file a timely extension for your C corporation tax return, October 15th of 2026. If I adopt the plan in December 2025, how can I make contributions based on income that I earned in January of 2025? Well, the industry best practice is for the plan to be effective as of the beginning of 2025, as of January 1st, 2025. So as long as the plan is adopted by the end of the year, as long as you establish the plan by the end of the year, you're going to be able to make contributions for any self-employment income earned and reported for 2025. My CPA tax advisor is informing me that employee contributions must be made by December 31st, 2025. Are you sure that I can make this contribution in 2026? Absolutely. And this is a common point of confusion with CPAs and tax advisors who might be more versed and experienced with full-time employer plans. So with a full-time employer plan, yes, the employees need to make their contributions by the end of the year, but the rules are different for self-employed individuals. This is clear per IRS Publication 560, which is the landmark guidance for self-employed retirement plans like solo 401ks, where they make clear that as long as the plan is established by the end of the year, that preserves the ability to make all types of contributions for 2025, whether employee, employer, and or voluntary after tax by the business tax return deadline, including any timely filed extension. And this makes sense from a policy perspective because many self-employed individuals don't know exactly what they made until after the end of the year. They might have a seasonal business where they're working all the way up until the end of the year. So they may not know exactly how much they made. And your ability to contribute is a function of your earned self-employment income. So the rules give that self-employed individual time to determine exactly how much they made, work with their tax advisor to determine how much they want to contribute, and then open up the accounts and make those contributions by the business tax return deadline, including any timely filed extension. Can I make a Roth conversion for 2025 anytime up until my tax return deadline in 2026? Well, that's a great question. So let's first define what a Roth conversion is. A Roth conversion is not a contribution. Yes, money is ultimately deposited in a Roth account, but it's being moved from a pre-tax account. It's not a contribution. A contribution is where you take money that you earned as a self-employed individual and you save it to your retirement account. A Roth conversion is taking pre-tax money that's already in your pre-tax solo 401k account. Could be a pre-tax contribution from a prior year. It could be pre-tax money that you rolled over from another retirement plan, like a former employer plan or a non-Roth IRA. And now you want to convert it from a pre-tax status to a post-tax status. So that is going to be taxable. So it is taxable for the year of the conversion. So if you want to have it taxable for the year of the conversion needs to be processed. The money needs to be moved from the pre-tax account to the Roth account on or before December 31st, 2025. Now, that's also going to be reportable. That needs to be reported by the plan as a taxable pre-tax to Roth conversion. We handle that reporting as an optional free service for our customers. So we will prepare the 1099-R for our customers. Now they need to just simply let us know at the time of the transfer by submitting an online form that they can do quickly and easily on our website, mysolo401k.net/forms. So if the information is provided to us in a timely fashion, then we'll prepare that 1099-R as an optional free service. In other words, no additional charge. All right, wonderful. That takes us to the end of the slides that we wanted to share. We do want to turn to the questions now that are being chatted up. We thank you so much for chatting up those questions. Just quickly, before we turn to those questions, if this information is helping you feel more confident about your future, please take 1 second to like and subscribe, whether you're on LinkedIn, YouTube, X, Instagram. Liking will tell the platform that the content is valuable, which will help other solopreneurs, other advisors like you find it. Subscribing guarantees that you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. So please don't hesitate to like and subscribe. Next question. I currently have a Roth. How is the 5-year rule affected if I open a solo 401k Roth? Do I get credit for the time my original Roth is open? So I assume you have a Roth IRA, in which case that's not relevant to the 5-year Roth solo 401k rule. So in order to take a qualified distribution from a Roth solo 401k, the individual needs to have had that Roth solo 401k account for 5 years and be at least 59 and a half years of age. So if you're making that 2025 contribution, and that's the first time you've had this Roth solo 401k, that's going to start that Roth clock as of January 1st, 2025. And then as long as you keep that Roth for 5 years and you wait till you're at least 59 and a half years of age, the individual can withdraw money from that Roth solo 401k totally tax-free, including the gains. Great question. Sorry, came in now just as you were discussing my question. Can my Roth or traditional IRAs be connected to this somehow? Well, you most certainly can transfer money from a traditional IRA to the solo 401k, and we're very hands-on in helping customers through that transfer process. For example, preparing the paperwork that might be required by the by the traditional IRA provider. But the Roth IRA rules would prevent Roth IRA funds from being transferred to any 401k, including a solo 401k. So money cannot be transferred from a Roth IRA to the solo 401k because of those Roth IRA rule restrictions. All right, it looks like that takes us to the last question. We'll see if any more come in. We do want to take a moment to invite you to our community. We have the largest community of solopreneurs, solo 401k owners, just other advisors around this topic. We have over 30,000 members, which means we have vibrant forums. We have a library of videos and webinars. It's totally free to join. It's not just limited to clients. So please don't hesitate. It's free to join. All are welcome. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. Looks like we might have one question come in. We'll give it a moment. Here it is. Here we go. This is just a regular IRA, not self-employed. So I can contribute for 2025 and then somehow connect it to the solo 401k. So when you say connected, so taking a step back, a solo 401k is a 401k for a self-employed person that has no non-owner, non-spouse employees. So this is a 401k account. It's not an IRA. An IRA is an individual retirement account. Anybody could set up an IRA. You don't need to be self-employed, in other words. In order to set up a solo 401k, you need to be self-employed. Now, the question is, in terms of connecting it to the solo 401k, you can roll over money, if that's what we mean by connected. You can roll over money from the pre-tax IRA to the solo 401k, and we'll help you with that rollover process. So if that's what we mean by connected, yes, it can be done. Do you support Mega Backdoor Roth contributions if I've already maxed out an employee portion at the W-2? Yes, our plan would certainly allow for that. So our plan most definitely allows for Mega Backdoor Roth. That's one of the top reasons that customers set up accounts with us. Now, when you make a Mega Backdoor Roth contribution, you're really making a voluntary after-tax contribution and then transferring the funds. either to a Roth solo 401k or a Roth IRA. So if someone has a 401k at a day job, not a 403b, we'll talk about the 403b in a second, but a 401k, those contributions that they made to the 401k do not reduce their ability to make voluntary after-tax contributions. So even though they might have maxed out those W-2 contributions, I should say those employee contributions to their W-2 and sponsored 401k plan. Let's assume they made $23,500 to their day job 401k plan. If they have the self-employment income to justify it, in other words, for example, at least $70,000 in self-employment income, they can make a $70,000 voluntary after-tax contribution to the solo 401k and then move the money to a Roth, i.e. the Mega Backdoor Roth. Now, if that was a 403b that they were contributing to at their day job, then you're looking at the 403b exception. So the general rule is that contributions made to a day job plan, in other words, a plan sponsored by an unrelated employer, you don't work there, you don't own it, you just work there. So contributions made to a day job plan, a plan sponsored by an unrelated employer, are not going to be aggregated. They don't reduce how much you can contribute as an after-tax contribution. That's the general rule. The 403b exception to that general rule is that contributions to a 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. The sum cannot exceed $70,000 for 2025. All right. Can employer portion also be contributed? Yes. So the employer contribution limit, the voluntary after-tax contribution, is not reduced by those day job 401k contributions. It applies at the plan level. So it's not reduced by contributions made to a plan sponsored by an unrelated employer. Fantastic questions. It looks like that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement.